Hey guys, welcome to this QA Thursday. In this session, I'm going to talk about common mistakes that really smart, intelligent people make in trading. And you might recognize some of these mistakes too. And I'm going to go over chart examples, and I've also prepared the slideshow as well. Before we start, I want to actually talk about this quote, which I really like. And that is, amateur traders focus on being right, whereas professional traders focus on making money. I love this quote because it's just showing that, it's okay to be wrong, but it's about managing your risk and not being over leveraged. Intelligent people are very much focused on being right in trading. They're very much focused on being right every single time, and often to their detriment. But professionals are more focused on, okay, I've entered a trade, I've made some money, get out. I've entered the trade, I've lost money, get out. It's very much a case of cutting your losses, knowing when you're wrong, okay? It's obviously you need to have some level of intelligence, as long as you're average or above average, that's enough. When you get to the point where you just look a bit full of yourself, that can really be a detriment to you in trading, I think. Because trading is a game of discipline. It's a rule-based game, essentially. There's a set amount of rules, and when you break the rules, there are consequences, regardless of how intelligent you are. So these are common mistakes made by really smart people, and just people in general as well. So the first thing I would say is that very often people quit too early. Okay, this is kind of a practical example. People have unrealistic expectations, and this is reality. In the first year of trading, you probably will not make any money, okay? It's completely understandable, and don't beat yourself up about it. But in the first year of trading, you're just getting a feel of the market. There's changing market conditions. I remember when I started, my first 2 months were really good at trading because the market was just crashing really bad and I was shorting everything. But as soon as the market changed from a trending market to a more range-bound sideways market, my strategy didn't work anymore. And so yes, you might have months here and there, but the odds are you probably will give the gains back later on in the year because eventually your bad habits will catch up to you. Okay? And ultimately, hard work will make up for when talent doesn't make up as well. But the next years, so of course everyone's route is different, right? But years 2 to 3, very often you get to the stage where you filter out the bad trades and you just think, okay, so I've got the strategy. Okay, maybe it works better on this time frame. Maybe I'm better off trading in the certain US session. Maybe I should wait a couple of minutes, after the US session, or 30 minutes. Maybe I should use this strategy in a trending market, and I should use this other strategy in a range-bound market. So whenever you're able to cut down and really hone in on the details, then you're able to reduce kind of the bad decisions, and eventually a major milestone is getting to the point where your good decisions equal your bad decisions. You have to honestly pat yourself on the back for that. It's not a small thing. Being consistent, obviously, is when your good decisions are greatly outpowering your bad decisions. So it's not about winning every single trade, but it's about getting to the point where your good decisions greatly outweigh the bad decisions, and that's what consistency means, essentially. And please understand that I've written it takes 2 to 5 years, because some people take 10 years, some people take 1 year. Everyone's learning curve is so different. I've written this here as well, and again, it's alluding to this diagram I mentioned before. There's so many aspects of trading, and a lot of these things depend on our wiring, right? As well as humans. We have different backgrounds, and this greatly affect us as well. For example, trading psychology and risk management together, I honestly think together they're at least 80% of trading. And a lot of trading is knowing when not to trade, sitting back. Because when you know when not to trade, when you have enough experience, that means that you do not make bad trades and essentially eat into your good trades. And so you're a net positive. That's also a very important skill. And that, of course, ties along with enough market exposure. And as you can notice, I put strategy and backtest algorithm as a very, very small aspect, okay? Another thing that really smart people, intelligent people do is they often overcomplicate their plan. So for example, they'll plan a trade, they'll have an entry and an exit. But then, for example, I'm going to use my example of Bitcoin. They often know price is going to an end target, but then they just scale out of everything too early and then hoping to buy back at a dip, which might not happen, quote unquote. And so by the time Bitcoin just has a small pullback and then goes up much higher, they just FOMO in at the top price. Whereas had they just maybe scaled out, for example, 70 to 60% of their position, they can at least use some of the profits to recycle and buy back at dips. That's like finding a compromise, I think. And so going back to the Bitcoin chart, let me give an example. So in this recent price action of Bitcoin, I was quite vocal about this. And so in the weekend particularly, I entered a long between around 27,330. I had a signal in my strategy. So this last week. So 27,330, I entered a long. And then my stop loss was around 26,500 based on various other confluences and my own personal scalping strategy. But then the problem I had was the actual exit signal of the strategy was confirmed at 28,200. But then on the MDX algo and just based on other indicators, once this initial scalping strategy, its exit signal was confirmed, the problem is I had another setup in another strategy. And so my question was, I was at the point where I also drew that harmonic as well. I posted in the group chat where I knew that Bitcoin was going to go to 29.2 at least, okay? And so the thing is, so how did I balance this certainty with uncertainty? What I did was when Bitcoin went to 28.2 the night before on Wednesday, I met my criteria. I exited 75% of my position. When I woke up the next day, I don't know what's going to happen. The next day, the price could go back down. And my actual initial plan was a scalping strategy, not a swing strategy. And so I'm going to stick with my plan that I devised at the time of entering. And so I closed the position, and I woke up next day, the Bitcoin was hovering around. It was kind of forming an order block, kind of support. And so what I did was, I took out 75% of my gains in this run-up. I left 25% to run. Then I recycled 25%, the remaining 75% of those gains into another long position here. And then we had that run-up, and I closed off like 90% of everything. And so this is how I balanced it. This is how you kind of balance it. An intelligent person would just enter a position here. They might say, look, I know it's going to 29.2, but they just might think, okay, I'm going to close off everything like here. Then I'm going to buy back in the dip. Well, there's always a dip, so I'm going to get another opportunity. But the thing is that in reality, when there's a strong uptrend, you might not always get a dip to buy. And so you're kind of banking on something that definitely might not happen. And so it's kind of sticking to your plan, but also balancing certainty and uncertainty. Very intelligent people, they want to find the exact exit. And so just going back to this, very often intelligent people, they just want to find an exact exit, and they think they're kind of rewarded for solving this puzzle to perfection. But the reality is that whilst this is a rule-based game in terms of risk management and certain other things, there's no right or wrong. It's a case of survival. Your job is to get in the trade and just scale out and just get as much as you can. You will never exactly determine the end of the move. So in some ways, trading is based on survival, I think, as opposed to just being right. The priority here is to be rich, not right? Yeah, so this is the thing just to be aware about. You might not always get the dip to buy, specifically in Bitcoin. Whenever you have run-ups in Bitcoin like this, very often Bitcoin just retraces to the 382 Fibonacci. Bitcoin doesn't go often to the 786 and strong uptrends. Even this strong uptrend here, Bitcoin actually only went up to the 3, that's roughly the 382, 236. And so it's about realizing that, look, I might not always get the dip to buy, but I don't want to exit everything. I might maybe sell off 50, 75%, and then I have a portion of change to deploy later. And that's how you essentially avoid FOMO like really intelligent people. Another thing, common mistake is people use and really misuse discretionary indicators like RSI and MACD and often sometimes Bollinger Bands. And sometimes these indicators, they have a use, but it's about using them properly. Sometimes you hear things people saying, oh, I'm short because RSI is overbought. Or sometimes people say, oh, I'm long because there's some bullish divergence on the MDX algo. Of course, you don't want to use too many indicators. Of course, this is going to lead to analysis paralysis, right? Have you noticed, for example, in certain Bitcoin run-ups like this, you see the MDX algo 5, and of course, there's a link in the description if you're interested in this indicator. It's one of my favorite indicators. But this is bearishness here on the MDX algo 4. But if you had shorted that at that exact moment, you would have got stopped out here. And same here. If you had noticed here, there's bearish divergence right here, and if you entered the short position because of some bearish divergence, you would have got stopped out here. So my point is that these bearish divergence, they're often telling you what you already know, and of course, there's definitely value in this. You could definitely, if you have other things and the other stars align, this is an added tool. But you don't want to just short based on this. And similar to RSI, if you had shorted because RSI has peaked here, over here, you would have got stopped out here again. Because again, RSI does not in any way mark perfect reversals. It's more about telling you that the buying pressure is starting to peak. And so you have to use everything in context. And specifically looking back to May 2022, Bitcoin was crashing really hard. RSI stood undersold for so many days, and people kept buying and just getting stopped out. The point is that you have to realize often these indicators are lagging as well. And they have use, but you need to realize everything has context. So in this, for example, right, if Bitcoin has ran up like this, but then pulled back, it's very unlikely for this next run-up to match the same extent and length of this run-up here, right? Because, look, like, come on, if there's a huge amount of momentum here, is it really likely for Bitcoin to maintain the same level of momentum in the next run-up? It becomes less and less likely. Because, of course, there's only a certain amount of fuel in the market. So you have to bear in mind that there's already bearish divergence by just logic as well. Obviously, the indicators are a great tool. The indicators are great because you'll often miss certain subtle things, but you know yourself there's already bearish divergence here. And so indicators just affirm that. You have to realize that all these indicators, they're very great. And you have to really realize when to use them and when not to use them, and ask yourself, is this indicator just giving me and helping my overall analysis, or is it actually giving me specific trade execution and entry? That's something to really consider as well. And this is what speaking of, this ties into the last point. Often retail overuse discretionary indicators, and ultimately less is more. It's better to use 2 or 3 things that actually work, that you can consistently, don't get analysis paralysis, but it's enough for you to actually trigger your entry, rather than relying on 18, 20 different indicators. I do definitely recommend checking out this video over here. This is my last YouTube channel video. And this is also based on the live stream. It's like a summary video. So it's in a sense looking at how to effectively manage your trading routine. And this video is pretty much outlining 18 to 25 things as a checklist that I do pretty much every day. Things like long to short ratio, open interest, all these things that I look at harmonics. And just, you could go through that list and you could check it every day. And you can see does this suit your trading style? And you might often miss certain things that you would not have otherwise picked up had you not had such a structure. And so this is the thing. You need to really separate the things that are needed for your analysis in trading. So for that, you might use 18, 20 things. But to actually enter the trade, you might not only use 2 or 3 indicators. And so separate these things out. Don't mix analysis indicators versus execution indicators. Next thing. Often very smart people, and people in general, there's often a herd-like mentality. People always think, oh, well, the majority are thinking this, and so therefore you should follow the majority, because actually the majority are right. Okay? Very often you get a phone call from a mate saying, get in before it's too late. Very often, very intelligent people, they're very much reliant on research and reading all the news, being up to date. But you have to realize that the news often already prices into the actual chart action. And so you have to ask yourself, are you really getting access to that news very early on? And so very often if your friend is saying, get in before it's too late, the odds are the move has already happened. And an early warning flag, of course, is if you have to say to yourself constantly on a daily basis, okay, should I long this or should I short this? What should I do? If you find you're in that situation, then perhaps take a break, because it's probably an early warning flag that you probably are not just quite ready to trade, or you might want to open a small account, because you should know you should eventually know. Of course, I understand if it's your first year of trading, I completely understand, but beyond that, it's just, you should really know what to do yourself in this situation, eventually. Of course, community and Discord is great. You're able to learn from the mistakes of so many people like myself who've actually had to go through this with really little mentorship and kind of trial and error. And by joining this community, naturally, you're going to fine track and really speed up your learning process. You get to avoid pitfalls that other people have made. And the thing is, you really don't have to learn from your own mistakes. Why not learn from the mistakes of other people? Please don't misuse community and Discord. You should not see Discords as a signal service, because in the long run, signals do not work. I think, look at the group and the Discord and see, what are these people posting? Does it tie in with my own trading style? And how can I implement this? And you need to do further research on these things. People can't spoon feed you this. And I think one of the hard aspects of trading is that there's no set career pathway like in other things like medicine or law or architecture or engineering. A lot of it is self-learning and pretty much learning by trial and error. The next thing, intelligent people naturally love puzzles, and intelligent people often really crave intellectual stimulation, right? Trading, of course, is a puzzle, but sometimes we can get carried away, and this dopamine fix of constantly in a trade can sometimes be to our detriment. We sometimes confuse the dopamine fix with actually a high quality setup. So sometimes people just purely for the dopamine fix of being in a trade will just open random trades, because otherwise they feel FOMO, they feel left out, they don't get into the price action. And so I understand that if you're from a traditional workplace, you're very much taught you should work hard for money, and you should work hard, clock in, clock out. But trading is very much opportunity driven. And of course it can be addicting initially, but it's very much, some days you might have 1 trade, other days you might have 3 trades, some months you might have 4 trades, some months you might have 60 trades. And so it's very much opportunity driven rather than clock driven. And so this is the thing, very intelligent people, for example, I have this rule that if I have 3 consecutive losses in a day, I just stop trading. And that's kind of an internal stop loss, because if you've lost back-to-back trades, then there's just something off maybe that day. Maybe the market condition was unfavorable to you, maybe like woke up on the wrong side of bed. But very intelligent people, they just have 3 losses, they just keep trying until they win the next trade, eventually blowing up their account. This is very much, you have to be kind of laid back a bit. You cannot be too needy in trading. You have to sometimes just let go. And the market really feeds off desperation. I'll talk about that later. Yeah, but this is what I'm talking about. Trading involves so much. It's not just one aspect. I mentioned about this earlier as well. Trading psychology, risk management, and strategy. And of course, other things like enough market exposure. Very intelligent people really tend to confuse quitting with taking a break in trading. Of course, as humans, greed and fear really rule us. And naturally, the fear of losing money is often worse and more strong than the greed of getting money. But we have to appreciate that very often we have personal problems. And for example, if you're working long hours, you might have a tendency to come home and just force useless setups purely because you don't have the time to trade. And ultimately, as I said before, the market generally favors with the people with a really positive and calm, neutral mood. Very often when we trade, we often think, oh, trading has to work because I'm in so much debt, or it has to work for me because I need it to work. The reality is that the market does not care about us. The market is brutal. It's so savage. And ultimately, we have to learn how to just enter the trade and just let it play out and don't get too obsessed with staring in front of the screen. We have to have that kind of confidence that the edge will eventually work out once you get to that consistency stage. This mindset of every trade is just part of a statistic. Each an individual trade of mine does not matter. It's more about the overall net result. Intelligent people are more focused on being right in every single trade. And often to the detriment that they use no stop loss and they just go underwater and they just keep adding and adding because they want to prove a point that their trade worked. They're more focused on being right rather than actually producing good quality trades. It's very easy to actually get into this trap without actually knowing about it, which is subconsciously as well. So I think it's a really good thing to talk about. Next thing, people often think, oh, I will change when my account size is 100k. The reality is that it won't. As children, when we're very young, we have neural wiring. It's harder to remove bad habits than to learn new skills. Like, for example, I play tennis. And so when I started playing tennis, initially I had a one-handed backhand. But my coach really told me that the reason why a lot of my games I was losing was because the one-handed backhand wasn't good enough. It wasn't good enough to... It was quite defensive, but it wasn't really offensive. It had to be more attacking, I think. And so, because I played badminton before that, it was very hard to remove that one-handed backhand in tennis. And so eventually, through time, I eventually started developing and practicing my two-handed backhand. That process of removing the one-handed backhand and switching to a two-handed backhand was really, really hard. It took a lot longer than someone else just learning a two-handed backhand. My point is this. Why am I talking about this? Well, if you're using a small account and you're constantly using high leverage, 10x, 100x leverage, because you think, okay, look, once I make a lot of money at 100k or whatever money is a lot to you, then I'll start doing proper risk management. Nothing changes really. Your habits are just amplified. If you were risk taking and just had no respect for risk management before you had that money, you'll probably do the same thing. Just look at these people who have a lot of money, who have like 8 figures and 7 figures. A lot of them are just doing the same habits. And so my point is that I know it's very frustrating to have a small account. My point is that there's different ways to get funded. There's different ways to scale up. And believe me, if you're consistent with a small account, the money will find you. And also ask yourself, when you get to the point of having 1 million or 2 million, do you really want your account to fluctuate every single week between 1 million, 900k, 500k, 2 million, 200k, 100k? Surely it's just better to be consistent growth every month. And one of my rules is that I don't want my account to ever go below 10% equity value. Because ultimately, the whole point of trading is capital preservation. The good habits start now because it's harder to remove bad habits than to learn new skills. And a big account size does not necessarily change bad habits. This is my risk management table. You can, of course, take a screenshot. And I've spoken about it in so many videos. As you can check out the YouTube channel where I post these videos as well. But essentially, I definitely would vary risk based on your account size and your general confidence as well. If you've got smaller accounts, as you might risk 1 to 2%. I understand that. Maybe in some cases 3%. Because $30 of $1,000, you might not think that it's not the end of the world. But as your account size increases, you have a lot more to lose because your losses are more exponential as well. And so perhaps maybe risk 0.5% or 1%. Maybe if you're more confident, maybe 1 to 1.5%. And as you get even to this next category, you want to risk less. Maybe half a percent of your account trade. Maybe 0.25% if you're more confident. And so this is also contributes to the exponential factor, but you have to also bear in mind that it's about longevity in this game. It's not a game of being right, because you could be right on a trade and you could win, right? If you only have a couple of attempts before you blow up your account, you're not going to live to fight another day for your actual edge to catch up. This is a marathon, really, not a sprint. And so last note, this is one of my favorite quotes, is that losers focus on winners, but winners focus on winning. it's very easy to overanalyze and think like a smart person, really intelligent, just constantly focusing on other people's success. You have to realize that everyone's journey is so different. Don't compare your chapter 10 to someone else's chapter 20. People have had different hardships in life. Someone might not have had a silver spoon. Someone might have found things quite difficult initially. Everyone has their own battles, and that's completely fine. Don't let anyone tell you otherwise. Just focus on your own process. Because believe me, imagine when you actually understand the skill, when you're in your 50s, 40s, 30s, or 60s, or 70s. Imagine how lucrative this will be just to be able to do this from your bedroom. It always baffles me how very often very intelligent people, they just have this sense of entitlement. Sometimes they just think, oh, well, I'm so prepared to work so many years for this degree or this job, 20, 30 years, and I'll wait till I retire till 60 or 70. And there's this sense of delayed gratification. They're able to just do 9 to 5 every single day. But once they see a trading screen, they see numbers on a screen, that sense of delayed gratification goes outside the window, purely because they know how quickly they can make money in trading. Everyone's route is so different, and losers focus on winners, but winners essentially focus on winning. So guys, that's all I have to talk about today. Thanks a lot for watching, and it's really good to see some really new faces. And of course, do check out my YouTube channel. This is where I start posting really the updates and market updates, and also my passion for crypto, and I also post recordings here as well. Well, thanks a lot guys for watching, and I'll catch you in a bit.